Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
Today, CIBC Wood Gundy's Ross Clark comments on the wild ride for the Canadian dollar the past week. Inside Track President Eric Hadik shows us how to take advantage of investment cycles. Bayhorse Silver CEO Graeme hopes changes can happen fast enough to save the venture exchange. We'll talk to Ross Clark right after this.
Always consult your investment professional before making any investment decision.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Yes, Jim. Nice to be with you.
Currency watchers had a very busy week.
This was a very large week when it came to whether it was the Japanese yen, the move in Europe with the euro, Canadian dollar, some pretty wild swings this week, doing very, very well the first half of the week. We basically had rallied the better part of 5 cents off the low, and most of that was supported by the oil market. But as of Friday, economic numbers, the employment numbers in Canada pretty soft, so you've got the Canadians starting to reverse down, and the oil market has found a lid at the in the mid-30s, in that 33 to 35 range. So yeah, that's some big action there. Now, on the U.S. dollar index itself, and this is one of the items that I like to keep a really close eye on. It took a pretty hard hit. We were just shy of par on the index this time last week, and traded down to 96 and a quarter as of Thursday and Friday morning. That is pretty important because it's come down to its longer-term moving average. Take a look at a 200-day and a 50-week moving average, and this is an important support level right in here. The dollar has given up half of its gains it had from the summer lows, and when I take a look at the long-term cycles, we look at a big 16-year cycle in the dollar index, and at this point in the last two cycles, 1982 and 1998, it went through a corrective process, and there were two styles. The first one, the 1982, the correction was about this deep, gave back half of its recent gains, held at the moving average, and then turned up and went to new highs. The one in 1998 had a short pause here and then took a harder break before turning up. And I'm still of the mindset that U.S. dollar is in a bull phase. We're looking for the 109, 110 range, but we have to put in a base here first. So the lower end of the parameters for support would be around 90, and the index closed off the week at 97. So we're talking about maybe 7% of additional vulnerability in the U.S. dollar if it can't hold right in here.
The Japanese yen has seen one of its biggest increases in value in decades.
Yeah, the action on the week was quite something. We basically rallied from 79 and a half up to 83. You don't get you have to go back to when the Japanese decided that they were going to go through the devaluation, which was way back in early 2012, to see anything like this, and it was the reciprocal. That was the downside action. So with it now negative interest rates over in Japan, it's interesting to see how the carry trade will work, because it's very, very cheap to start borrowing over there and invest elsewhere.
And I noticed that the Canadian dollar did have that big bounce last week.
Yep.
On the same day that oil gained something like $3.50 a barrel. So maybe we should change the name of the loonie to the petro.
Right, the petrodollar. I have seen some of those posted around recently. You know that the Canadian dollar and the oil are basically one and the same when it comes to tracking. There's probably a 95% correlation on those. So for the oil market to have had its first bounce off the lows, and you typically are going to see about a 5 to 7 day bounce. It's going to be in that 30 to 35% bracket. That's what we saw. I think it was 33% move off the $26 low. It's normal for oil to then go through a basing phase. You don't find V bottoms in the oil market when you look back. So ideally, Oil, which closed off the week just above 30, it probably goes down and retests the $26 low, or maybe undercuts that by a few dollars, and then you start to look for some basing action in there.
What about the equity markets in general?
Well, in general, they've got big overhead resistance. We had like a week and a half here of consolidation after the hard break. We have found resistance, depending upon the index, anywhere from a 35 to 50% retracement of the break from early in the year, and that's going to be important overhead. We have talked about how the first bounce off the bottom, which we now have behind us, is going to become critical, because what you should do in a classic non-incumbent election year in the States, where you've got a president who's he's serving his 8th year, is that you have pressure in early January, which is typical to most election years. The recovery rally then ends up with a lid on it into the late January, early February stretch, and then you put in a secondary low as you move into February. Now, that secondary low typically will make a lower low than we saw in the first break. So, looking at the S&P closing off the week here at 1880, there's probably decent support down in the 1770 to 1780 range. Now, if it can turn from there, then you can set up for the next part of the seasonal on the election years, which will be a rally into March, April. And that's the way I'm going to be looking at it at this point. And with all of this volatility we've been seeing in equities and in currencies, there has been a flight to the two safe havens out there, government bonds and over into the gold market. Gold, we talked about it the last few weeks about needing to raise the stops underneath because it was having a pretty good move. Last week we talked about raising stops up into the 1110 range. We've closed this week above 1170, which is for me very, very significant, because in the last 2.5 to 3 years, the rallies have been capped just above the 200-day moving average. We've been up there 6 times now and failed. And this reminds me very much of some of the previous downtrends that we've lived through in the last 20 or 30 years. This one looks overdue for a much larger rally. And from a technical perspective, what we see in our work is that if gold can push through this 1170 to 1180 range, it could have a pretty good spike. And looking at probably something in the realm of $200 to $300 above this. So, and it doesn't have to be a long-term move. It's typically something that happens quickly and then can give back after that. But I would say, starting to break out, one would look for a pretty good short covering rally.
Ross, thanks a lot for chatting with us.
Nice to be with you, Jim, and have a good week.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. And Ross has just finished a report on gold. If you'd like to get that report, you can email him at ross.clark@cibc.ca. Coming up next, Eric Hadik on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik. He's the CEO and president of InsideTrack.com. Inside Track spelled INSIIDE. Very interesting. Eric, maybe explain to our listeners why the weird spelling for Inside.
Well, Inside is an acronym that summarizes the markets that were originally the focus of our publications. We have expanded a little bit beyond that, but it was the IN was for inflation markets, which really kind of was a catch-all for commodities in general. The S in the first I was for stock indices. The second I was for interest rates, D for dollar and currencies, and E for energy markets. So it was an acronym that just gave a little basic description of what markets were in focus. Obviously, though, you needed to see the explanation of that to know what it stood for, but seemed like a catchy idea at the time.
Eric, The equity markets, especially at the start of the year, took a huge pounding. Now we're seeing a lot of, up and down action. What has that done with the outlook for gold and silver?
I don't know that it has had a huge impact as far as altering what my outlook is for gold and silver. I came into the year looking for, two primary things to start the year off, and I actually was talking about these things starting in mid-December, and one was for stock indices to turn back down since the first quarter of 2015. I kept saying that I thought the real trouble would materialize right after mid-December, and that was based on a very uncanny weekly cycle that perfectly timed the September 2014 peak, which led to a quick sharp drop into October 2014. Then it was expected to time a late April, early May final peak in the stock indices, which came pretty much right on schedule. And then the next phase of that cycle, which is when you typically see a lower high and a sharper sell-off right afterwards, came into play in mid-December of 2015. So that was the first expectation that I had my readers preparing for. We got sell signals in the stock market in early November and then again in mid-December, and that was expected to trigger a sharp sell-off into the first phase of it being into late January, and then a larger phase into late April, early May of this year. And at the same time, throughout really from late 2014 through late 2015, the gold and silver outlook remained the same, that we'd be bottoming in late 2015, but that any sustained rally would not take hold until the very beginning of 2016. And so that too is kind of unfolding right on schedule. And part of it is certainly some flight to quality into gold when the stock market was showing some signs of weakness, but really silver has benefited more by the stock market bottoming out and leveling off, so that the idea of any sort of inflationary rebound isn't squelched by stock markets going into the tank. So it all is working hand in hand. Stock market didn't alter anything that I've been looking for, and I do think that gold and silver are, my outlook has been that we would see the sharpest rebounds in the first couple weeks of February, but then a peak that could hold for a month or two, probably be one of those things where just as gold and silver are breaking through some key resistance levels, getting all the gold bugs excited and jumping back in the market finally, that's a good time for a top and a pullback, and to just foster more frustration before something bigger takes hold a little later in the year.
Is there a lot of renewed interest now in gold miners?
I'm hearing and seeing some of that, but I think there's been such frustration for a couple years, and a lot of investors have gotten burned that they're very hesitant to see it other than just a dead cat bounce or type of thing. And so I think that there's some reluctance to get too committed to getting back into the miners, and that's why I think that it's really the way that markets operate, and I think that you'll see this some more acceleration to the upside, and then you'll start getting that renewed interest, and that'll be the time when you see an initial top, and just, as I said, just kind of perpetuating that frustration. But this time I think it will be different, because I think the ensuing sell-off or pullback will be to a higher low, and then you'll see a more sustained advance in the second quarter of 2016.
Is it a matter of patience then that gold and silver is expected to do decently well by the end of the year?
I wouldn't say that it's just patience. I think it's certainly timing and not expecting too much from the different moves. I actually think there could be a period towards the end of the year where there's another sell-off, because actually in some of the gold indexes, gold stock indexes, like the XAU, there are long-term, multi-year cycles I'm watching that could allow it to retest its lows at the very end of 2016. And the scenario that I've kind of been drawing out and describing for my readers is that we see the first initial move up in gold and silver in 2016, then you see what in Elliott wave terminology would be the second wave pullback, gold and silver bottoming at higher lows, but the shares, the gold and silver stocks, could actually retest their lows or maybe even spike to slight new lows, and that could be on renewed weakness in the overall equity market. And we've seen that kind of divergence at every major turning point in gold and silver, at least over the last 20 years, where the metals peak and bottom often 6 to 12 months differently than the something like the XAU index. So it's not a contradiction, or it's not an unprecedented thing, and it would be a very typical wave formation, and would actually be a very bullish thing looking out at 2017, 2018, when a more dynamic type of advance would be more likely. So I think that timing is the real key, and also reasonable expectations from some of the moves here, not getting all giddy over gold going into the stratosphere within 6 months, because I don't think that's going to happen. So they're the two things. Unless you're just talking about buy and hold, then patience might be the most important approach.
Of course, in Canada, crude oil is so important to our economy, especially in Alberta and the Prairie provinces. What's the outlook for oil over the short and long term?
Well, we've talked about this over the last year, and nothing has changed with my cycle outlook that the first quarter of 2016 would be the most likely time for a major bottom, that the energy markets should plummet into that time frame, which they've done, and then that we would see a bottom ideally in January of 2016, which, among many other things, is also a 7-year cycle from the bottom in January of 2009. And I know I've mentioned this too in some of our previous conversations, that there were several petro-related currencies and other markets that were showing similar cyclic expectations, and one of them being the Canadian dollar, another being the Russian ruble, that the first quarter of 2016 had a lot of cycles converging, also some key indicators that I watch were setting up and looking like it would take until the first quarter of 2016 before they would be completely primed for a bottom, and even price objectives to the downside that were finally met, one of them being a spike below 70 on the Canadian dollar. And so all those things are coming together. If I were to pick the month with the greatest synergy of cycles for a bottom, it would be March of 2016. But I've also learned not to get too precise when you're at a potential major bottom and when you've reached some price objectives. So first quarter of 2016 is the overall expectation for a bottom. March 2016, I could see a retest of recent lows, maybe a spike to slightly lower levels. But then starting in second quarter of 2016, I think you'll start to see more of a rebound in the Canadian dollar and some of those other petro-related markets.
You're listening to This Week in Money. I'm Jim Goddard. My guest is Eric Hadik, president of InsideTrack.com. The U.S. dollar has enjoyed a huge climb over the past couple of years. Is that about over?
I think that 2016 certainly holds the potential for a major top, at least a multi-year top, and I don't think that we have seen it yet. There are two key cycles out in the second half of 2016 that I've started to describe and elaborate on, that I'm going to be giving more detailed analysis on in the coming months. But I think that the dollar could still have another move up in second quarter of 2016, and maybe the third quarter. But I do think that it's going to be part of an overall topping formation, because I do think 2017 is when new troubles are going to start to materialize for the U.S. dollar. And I think that some of that could be a much bigger picture type of thing, not even just U.S. economy or interest rates or trade balance, but some real macroeconomic and even the whole global forex and reserve currency status starting to shift. And I think that, one kind of key confirmation of that could be the October 2016 inclusion of the Chinese yuan in the IMF pseudo currency, the XDR, also known as the SDR, strategic drawing rights. I think that is just another step in a major shift that's happening that is going to ultimately weigh on the U.S. dollar and start to diminish its standing in global finance and economy and trade. I'm not saying that it suddenly just disappears out of that role, but that its primary significance will start to diminish. And as we know with the markets always overreact to things. So I think when investors start to really sense that or realize it's a reality, they could overreact in selling the dollar. But this is looking out over the 3 to 5 year outlook, possibly some of it in the 1 to 2 year outlook.
What about investors who are near retirement? Where should they be putting their assets?
That is the $64,000 question. And I think that because things change and evolve so quickly anymore these days, that I'm not comfortable even describing something that I think could be a consistent benefit for 10 or 20 years down the road. I think that timing the markets, at least to a certain degree, that doesn't mean trying to day trade them and catch every little move, but I think you need to time the things that are evolving in global finance, in even in commodities. And so again, it's something that I don't really have a good answer for. I do think that precious metals are going to be beneficial for a few years here, but even looking out past 2018, 2019, I'm contemplating some unique scenarios that could start to unfold out then that might really shake things up and change the status quo. So I'm more focused on 6 to 12 month, 1 to 2 year type of trades and investments than anything beyond that.
Negative interest rates have just been introduced in Japan. They've been a fact of life in Europe for some time now. How has that changed the outlook for investment?
I don't know that it's changed that much either. More just a continuation of what has happened with global currencies versus the dollar, and those type of extreme things are the type of events you expect near a major turning point. So that would really kind of corroborate the idea that the U.S. dollar versus a lot of the foreign currencies is poised for a final rally, but that we're starting to see events take place that are kind of capitulation and near a blow off top or bottom. So I think it's more a culmination type of signal than it is the inception of something new.
Do you think we'll ever see a world currency, or are nations just too, ornery or irascible some kind of term that there's always some kind of major friction between major players, that to see them cooperate on a single currency would be impossible. And also there's so much money tied up in the currency trade. Would people ever want to give that up?
Well, I think it would probably be a majority rules type of thing where you could get, and I expect to see, a large, whether it's a basket of currencies, and that's where something like this, the IMF's XDR comes into play, even though up until this point it's only been utilized as an isolated thing where countries that are receiving aid may utilize it to convert currency. But I do think that it's something that when you talk about the friction, and I talked about this a couple of years ago with the euro, and that when the euro was going through some major cycle highs in 2011 and then some secondary cycle highs in 2014, I kept explaining where I thought that the euro was going to dive and that they needed to see a very significant euro crisis before the euro currency would really gain any more credibility, shall we say. And that would probably also involve certain nations being bumped out of it, maybe others coming in, but that type of true unity usually only comes about as a result of crisis. So I thought that was something we would see, and 2014 and into early 2015 with Greece was kind of a precursor or a example of the type of things that could unfold. And I think that Europe is still in for more of that to then solidify whatever becomes of a common currency there. And I know there's the whole debate too about when Britain is going to hold a vote or a referendum on being part of the euro or not. All those types of things, I think, need to unfold. You need to have some sort of panic, and I think that also applies on a global scale, that financially it may take a real meltdown of some sort before there's enough of a consensus to form some sort of global currency, and whether, that may be part digital, part real tangible currency, and would probably involve currencies of many nations. So I do think it's coming, but I think that there's a lot to unfold before there's enough willingness to do that. And I think that you also need to look at moves that some of the bigger nations, like the BRICS nations and like many of the Asian nations, have started to put together since 2014, with both the BRICS Bank and the New Development Bank that was put together by the BRICS nations, and then also the Asian Infrastructure Investment Bank put together by China. Here, if the yuan does get included in the IMF's currency in October, that will give China a significant hand in 3 different major global banking / currency type of entities, 2 of which have just come about in the last couple of years. So it certainly is going to give them a lot of sway and a lot of influence over global finances. And I think that's part of the shift we're going to see starting in 2017.
Eric, how can people find out more about Inside Track?
Well, they can go, the best way is to go to our website, and the flagship website, although I'm doing a complete revamp on it, so some of the information there isn't right up to date, but that's Inside Track, INSIIDETRACK.com. But for a lot of the current analysis and examples of publications, you can also go to 40-Year Cycle. That's the number 40 and then the words yearcycle.com. And that's where you're going to find a lot of current analysis and publications. They're really the best ways to to take a look at that, and then through either of those websites, they can contact or email us and either inquire about trials or additional samples or subscriptions.
Eric, thanks a lot for being on This Week in Money.
Thanks for having me back, Jim. It was great to be here.
My guest has been Eric Hadik, president of InsideTrack.com. Coming up next on This Week in Money, Graeme O'Neill. He'll be discussing his concerns about the venture exchange.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Graeme O'Neill, president and CEO of BayHorseSilver.com. Welcome to the show, Graeme.
Well, thanks. It's a pleasure to be here.
Graeme, we had a town hall meeting in Vancouver 2 weeks ago to discuss the very real possibility that the exchange could disappear because of overregulation and being too costly for investors to use or for companies to use to raise funds. What was your impression of the meeting where 400 people showed up, but nobody from the major media?
Well, I was disappointed that the major media wasn't there. I mean, this is a serious issue in my estimation. Now, as a president and CEO of a public company, my job is to look after the shareholders, and it's to make sure that I create value for them. And when I see inequities happen, as I see every single day in my market, I have to speak out. So I think what has happened is the venture exchange has opened a Pandora's box. And, the cat is out of the bag now, and they're not going to be able to put it back in very easily. There's a lot of issues that have to be addressed, and either through the exchange or with the exchange making representation to the regulators to clear some issues up. So I think it's a significant problem, and it's far greater than actually most probably realize.
What kind of risk is there to the Canadian economy if the venture exchange collapses due to overregulation and charging its customers too much?
Well, it's not just overregulation and charging customers too much. There's so many abuses happening that the cost of the economy is going to be huge. I don't know how much money has been raised over the last 10 years by the juniors, but it all goes into the economy. And the exchange pointed out that they have stakeholders. Well, actually, they don't have stakeholders so much as they have dependents. So, except for the companies and the shareholders and the money-raising side, they're the stakeholders. All the rest are dependents. They're dependent upon us to provide jobs, to provide growing businesses, and to provide, taxable revenue that will grow the economy. And that's going to be a significant chunk that goes out the window if this is allowed to proceed the way it has.
What was the mood at the meeting, and what was the mood after the meeting?
Well, it was both angry and frustrated. Gentleman beside me, he commented, this is just like rearranging the chairs on the deck of the Titanic. And that was funny he said that because I had written that in my letter to the exchange. And others had commented it was just putting lipstick on a pig. I think the exchange is going the right way, and they're taking it seriously, but the measures they propose are not going far enough because it's not comprehensive enough, and it's not addressing the issues that are directly affecting the exchange participants and essentially taking money out of shareholders and investors' pockets.
Graeme, one of the things that really impressed me and shocked me at the same time was that the current rules and regulations on the venture exchange exclude 97% of Canadians from investing in it. Can you maybe explain how that happened and why?
Well, that comes down to the know your client and to the appropriateness of the investment. I believe it's at 65 years. If you have a brokerage account, you are deemed to be not worthy of participating in the public markets, especially the junior markets, because it's too risky for you. It's not appropriate. Now, you look at, or I look at the markets today, and actually I see it as a gamble now. It used to be speculate to accumulate. and you take your acknowledged risks, and you go out there and you take your risk money, and you're prepared to lose it. But at the same time, there are people who are working actively and very strenuously, in fact, to help make your dream, your speculation become a reality. But the way I see the markets today with computerized trading, I see it as a gamble. There's people just running out there, day trading. There's manipulative practice happening that, albeit do not meet the definition of a manipulative practice. And maybe that's what IROC is trying to prevent, is because no one in their right mind would go into a manipulated market. And I think that there's so much manipulation, so much abuse happening that maybe that's why they're doing it. But rather than just stopping the abuse and stopping the manipulation.
Graeme, what do you feel needs to be done to correct the problems on the venture exchange?
Well, that's a significant issue. I look at the big picture on everything. So most of the people at the meeting were talking about shorting's not an issue, this is not an issue, that's not an issue, but what about the zombie companies, et cetera, and so forth. What I saw as the big picture is the so-called zombie companies have been caused by the proliferation of regulations, the abusive practices that have been conducted, in my opinion, on through the exchange. As an example, I've complained many times about what I call the 1,000-share trades. A minimum board lot on the exchange is 1,000 shares. So when we see constantly, and it's not just Bayhorse, it's every single junior company out there, we see these minimum board lot trades. And if you think about the math, you wonder how they can afford to do it. Well, I was advised after the meeting that there were a number of houses reported to me, House 2, House 7 particularly. I've heard of other houses, and what they have is they have trading groups which hold 200 to 300 venture companies on their books, and you multiply that by 2 or 3 or 4 or 5 trading houses or trading groups, and they are looking to pick up half a penny. But that makes significant revenue stream. Now, the exchange has got a 0.003 cent cost for executing a trade. So a 1,000 share trade or a minimum board lot should theoretically cost $3. But I'm advised that these people in these coterie of groups are executing these 1,000 share trades for $1. So that means someone's subsidizing them. Is the exchange saying, well, we'll discount the price for volume? So, but most of those minimum board lot trades are on the sell side. And it provides what I call relentless selling pressure that affects the market psychology. In essence, it's saying to the investor who looks at particularly a particular company and saying, I'd like to invest, and then they see the continual, hold at a specific price. They say, well, they're not going to let the stock price rise, so I'm not going to participate. So, unless you have positive market psychology, things are not going to go anywhere. Now, secondarily, or next, front running. That's a regulatory issue, but I've been advised by numerous brokers. I acted like a lightning rod for a lot of people when I wrote my letter to the exchange, and they were calling me and they were complaining about all kinds of things. So front running is blatantly illegal. It's not permitted. Brokers can lose their licenses, and that was brought up by Dorothy Hoffett at the broker at Wolverton at the meeting, the town hall. But what's happening is that with all the computerized trading, essentially what happens is if a broker puts in a market order, he goes to the back office, it goes in the line, and it goes down the slow boat to China route before it gets to the execution platform. Well, the way it's been explained to me is that as it goes down the line, passes a switch, it triggers an algorithm, and that algorithm says, oh, this guy's going to sell the stock, let's get in front of him. But the algorithm routes that front run on the fast lane. It goes on the freeway. So it gets to the execution platform before it. Now, we think in terms of seconds. This is multiple fractions of a millisecond, microseconds. It's instantaneous, but it happens. You know, and this is not just Dorothy. This is 2 or 3 or 4 brokers. This is, you know, a person who advised me he executed a trade. There was nothing else happening. He saw the trade go through, and whoops, he was told by his broker that he only got 5,000 shares sold out of 70 out of a market order. So that is abusive, you know, so that's another issue. Then you've got shorting. Now, IROC and the exchange says it's not an issue. There was a study done. It's not an issue. Well, the study was done in 2010, and it was done over a 3-year period. But I question why shorting is permitted at all in the on the venture exchange. Like, the venture exchange is really an incubator. It's to help companies get access to capital to grow and to proceed on to the main exchange, the TSX, where they can generate revenue. But if you put a bunch of psychopaths, and I use that word advisedly, into a kindergarten, you know, it's no wonder that the companies are all in disarray. So this is essentially what's happening by allowing shorting, by allowing these minimum board lot trades, which are trying to take half a penny profit out of the market. You're effectively putting, you know, wolves in with babes. And the companies, the people that provide the money, the investors and the companies and the shareholders, they put their faith in their money on the line that we're going to be able to build companies that will eventually translate over into the TSX. But we're literally torn apart by these nefarious, and I'm going to call a spade, just nefarious and abusive practices. And it may be that with the advent of computerized trading, it's an unintended consequence, but it's happening.
Graeme, do you have any confidence after this meeting that things will be changed quick enough so that the exchange can survive and provide a useful service?
No, I don't. I don't have confidence in it because the exchange is only doing what they can do. They probably haven't even really addressed all the regulatory issues and the abusive practices that are slowly coming to light. And they need the regulators to do that, and regulators are way too slow.
Don't these people realize if the venture exchange dies, their jobs go with it?
Well, you know, the one thing that I've always found with government is that it doesn't matter what happens. You know, they just keep building their empires. You know, I'm a firm believer in Groucho Marx and his aphorisms. You know, he said, who are you going to believe, me or your own eyes? So when the regulators say that there's nothing wrong, we just have to look at the venture index and we can see there's something wrong. We just have to look at our daily trading and we know there's something wrong. So you know, the regulators will not address this because you have the issue of he who has the gold makes the rules. Now, the large financial institutions, they may not make the rules for the exchange, but certainly they influence the politicians who make the rules. And that's a cat that is certainly not going to go away.
Graeme, where should people go if they have some interest in Bay Horse Silver?
Go to bayhorsesilver.com. We were just interviewed by David Morgan of the Silver Report, and you know, he's very excited about our silver projects. But bayhorsesilver.com, you'll get all the information there.
Graeme, thanks for being on This Week in Money.
Okay, thanks very much for having me.
My guest has been Graeme O'Neill, President and CEO of BayHorseSilver.com.
And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Graeme O'Neill, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.